The silver distraction. This morning I watched silver hit $117.06 per ounce. That's the highest price I've seen in my 12 years as a private commodities analyst and physical stacker. And you know what? Everyone's celebrating like the game just started. Meanwhile, copper quietly broke through $6.41 per pound, a new all-time high. Uranium jumped 7.84% in a single session to $98.30 per pound. But if you're scrolling financial news right now, you won't see those numbers trending. You'll see headlines about silver's moonshot and think pieces from Wall Street Journal asking if the bubble's about to burst. They want you focused on the exit strategy for a metal that already moved. They want you staring at the shiny reflection while the engine of the global economy quietly melts down. Because here's what nobody's saying out loud. You can't build an AI data center with silver bars. You can't power a city with precious metals sitting in a vault. Something is broken in the plumbing of the world. And while retail investors are posting screenshots of their silver gains, the real wealth transfer is happening in two metals most people don't even think about. Do you think the silver run was parabolic? Wait until you see what happens when the lead time monster finally catches up to the energy grid. Let me be clear about what I'm seeing right now. We're witnessing a fundamental rotation from speculative precious metals into what I call industrial energy metals. This isn't a prediction, it's already happening. The price action is screaming it. Silver is a store of value. It's beautiful. I stack it myself. I have bars sitting in a safe deposit box right now. But copper and uranium? Those are necessities. They're the difference between having electricity and sitting in the dark. They're the difference between your AI-powered future and a fantasy that never materializes. Here's the promise I'm making you today. I'm going to teach you the structural deficit mechanism, the reason why high prices won't bring more supply in these markets. We're going to run the actual math on the global deficit. And I'll show you my personal battle plan for rotating profits out of silver and into two specific underdogs that are about to become the most important commodities on the planet. This isn't about abandoning silver. It's about understanding that the game has evolved. The smart money isn't asking whether silver can go higher. They're asking what happens when the world realizes we don't have enough copper to build the future we've already promised ourselves. They're asking what happens when utilities start competing with big tech for a finite supply of uranium fuel. I've spent the last few hours going through production reports, LME inventory data, and some frankly terrifying numbers coming out of Kazakhstan. What I'm seeing suggests we're not in a normal commodity cycle. We're in something that breaks the traditional supply-demand models. And the institutions? They already know. They're just not telling you yet. Most people think a shortage is when prices go up and supply catches up. That's how normal markets work. High prices incentivize production. Mines open. Supply increases. Prices stabilize. Simple economics. A structural deficit is different. It's a physical inability to meet demand regardless of price. The price signal is broken. You can offer twice the money, 10 times the money, and the supply still won't come. Let me give you an analogy that makes this painfully clear. Imagine everyone in a city suddenly needs a taxi at the same time. Every single person. You can offer the driver $10,000 for a ride across town. You can offer $50,000. But if there's only one car, the price doesn't create a second car out of thin air. It just makes the ride more expensive for whoever happens to be standing closest when that car shows up. That's where we are with copper and uranium. The car is gone, and no amount of money creates it faster than physics allows. Here's why this matters. A new copper mine takes 15 years to permit and build. 15 years. That's if you find a deposit worth mining, if you get through environmental reviews, if local communities approve, if you secure financing, if commodity prices stay high enough to justify the capital expenditure. That's a lot of ifs. We haven't built enough mines in the last decade. Not even close. And now we're staring at a demand surge from electric vehicles, renewable energy infrastructure, and AI data centers that need 3 to 4 times the copper of traditional facilities. But here's the mechanism that turns this into a trap. As prices rise, mining companies desperately want to produce more. Their margins look incredible. Their shareholders are demanding growth, but they can't. Because ore grades are dropping. 25 years ago, a good copper deposit might have ore grades of 1.2%. Today, we're mining deposits at 0.6%. That means you have to move twice as much dirt to get the same amount of metal. You need bigger equipment, more energy, longer processing times, higher costs. The price is screaming, produce more. But geology is whispering, you can't. And that's the trap. High prices should bring new supply. But the new supply requires a decade of lead time we don't have. Meanwhile, ore grades keep falling, which means even existing mines are producing less copper per ton of rock than they did 5 years ago. Think about what that means practically. A mine that produced 50,000 tons of copper annually 5 years ago might only produce 40,000 tons today, from the same facility with the same workforce. They're working just as hard, maybe harder, but the Earth is giving them less metal per unit of effort. Now, there's a specific number in the uranium market that broke this morning that makes this 10 times more dangerous. But before we get there, you need to understand just how bad the current supply situation has already become. I was looking at the boards this morning, and here's what I saw. Silver at $117.06. It's not really moving anymore. It's sideways, cooling off. The momentum traders are starting to take profits. Copper spot price, $6.41 per pound. New all-time high. Not a retest of an old high, a new high. This is uncharted territory. Uranium spot price, $98.30 per pound, up 7.84% in a single trading session. That's not normal. Uranium doesn't move like that unless something fundamental just shifted. Now let me show you the supply shock that's driving this. Glencore, one of the largest mining companies on the planet, just confirmed their 2025 copper output fell 11%. 11%. This isn't a forecast. This isn't a model. This is verified production data from an actual mine operator. When a company the size of Glencore misses production targets by double digits, that's not a hiccup. That's a structural problem. They're dealing with lower ore grades, equipment failures, permitting delays, labor shortages. The same issues affecting every major copper producer on Earth. And Glencore isn't some small player. They operate mines across Chile, Peru, Democratic Republic of Congo, and Zambia. When their global production drops 11%, that's hundreds of thousands of tons of copper that the market was expecting that simply won't exist. Supply forecasts built into current prices assumed that copper would be mined. It won't be. But the geopolitical situation makes this even worse. The US ban on Russian uranium kicks in by 2028. That's not very far away. Russia supplies a meaningful chunk of enriched uranium to American reactors. When that supply disappears, where does it come from? Kazakhstan produces 43% of global uranium supply, 43% from one country. And they're starting to pivot toward resource nationalism. They're realizing they hold leverage. They're realizing they can demand better terms, keep more production domestic, prioritize their own future energy needs. Now here's where it gets really interesting. And I'm choosing my words carefully here because some of these deals are under NDA, but the broad strokes are public knowledge. Big tech companies, Meta, Microsoft, others, are signing agreements directly with nuclear power providers. They're not just buying electricity, they're buying fuel. They're securing uranium supply chains before the public utility grid even knows there's a shortage coming. Think about that for a second. If big tech is already hoarding uranium fuel, what does that leave for your local power company? What happens when utilities start competing for a shrinking pool of available fuel and they're bidding against trillion-dollar tech companies with infinite balance sheets? That's the question keeping energy analysts up at night. And based on the price action I'm seeing, the market is starting to price in the answer. I know what the skeptics are saying right now. I read the same reports you do. Chinese demand is cooling. US inventories are rising. This is just a speculative bubble driven by momentum traders who don't understand the fundamentals. Let me address this head on because I actually think the skeptics have a point on the surface. If you only look at short-term inventory data in the United States, yes, you'll see a small increase. Warehouses have more copper sitting in them than they did 3 months ago. But here's what that data doesn't tell you. Global ore grades have crashed from 1.2% to 0.6% over the last 25 years. We're not building a surplus. We're seeing a localized logistical delay, while the structural deficit continues to worsen underground. Those U.S. inventories, they're mostly refined copper waiting for fabrication. They're not new supply. They're processed material sitting in the distribution chain. The problem isn't fabrication capacity. The problem is we're not pulling enough raw copper out of the ground to meet projected demand 2 years from now. I actually went through the LME warehouse reports myself earlier today. The inventory increase the skeptics are citing, it's about 20,000 tons spread across multiple facilities. That sounds like a lot until you realize global consumption is measured in millions of tons annually. 20,000 tons represents less than a week of global demand. Now let me tackle the other skeptic argument I keep hearing. The substitution myth. People say, if copper gets too expensive, we'll just use aluminum instead. Problem solved. This reveals a fundamental misunderstanding of electrical engineering. AI data centers require 3 to 4 times the conductivity efficiency of traditional facilities. Copper has higher conductivity than aluminum. If you swap aluminum for copper in high-performance computing applications, you get massive heat loss and energy inefficiency. AI chips are already running at the thermal limits of what silicon can handle. You can't afford additional resistive heating from inferior conductors. It's not a cost issue, it's a physics issue. The substitution doesn't work for the applications driving demand. And it's not just about conductivity. Copper also has superior thermal properties, higher durability, and better resistance to corrosion in high-performance applications. When you're building infrastructure that needs to operate flawlessly for 20 years, you don't cut corners on materials. So when skeptics tell you this is just speculation, ask them a simple question. If this is a bubble, why is Glencore's production down 11%? Why are ore grades falling? Why is big tech locking in uranium fuel contracts under NDA? The skeptics are looking at the paper price. Let me show you the hard math they're ignoring. The deficit math. Let's run the numbers conservatively. Based on current mining reports and projected demand, we're facing a deficit of approximately 300,000 tons of copper in 2026. That's the gap between what we can mine and what global industry needs to consume. 300,000 tons might not sound catastrophic until you stress test it against the AI factor. A single gigawatt of data center and renewable energy infrastructure requires 200 to 400 tons of copper. Just 1 gigawatt. Renewable energy growth is projected at 65% or more over the next 5 years. AI data centers are being built as fast as companies can secure power contracts. Every new facility is copper intensive. Every wind turbine, every solar farm, every electric vehicle charging network. Now let's add the automotive transition. An electric vehicle uses 180 pounds of copper. A traditional gas car uses 40 pounds. That's 4.5 times more copper per vehicle. Global EV sales are projected to hit 20 million units in the next few years. Let's do the math right now. 20 million vehicles times 140 pounds of additional copper per vehicle equals 2.8 billion pounds of copper. That's 1.27 million tons just for the automotive transition alone. And we haven't even talked about grid infrastructure upgrades, building electrification, or the baseline replacement demand from aging electrical systems. The U.S. electrical grid is, on average, over 40 years old. Much of it needs to be rebuilt regardless of electrification trends. That's a massive copper sink that exists independent of the green energy transition. Here's where the math breaks. If demand grows at 4% annually, which is conservative given AI and electrification trends, and supply shrinks at 2% annually due to ore grade decline in aging mines, you have a 6% annual gap. That gap doesn't close, it widens. Every year, the deficit gets worse. Every year, inventories drop further. Every year, prices have to rise to ration the available supply among competing users. The math doesn't work itself out. The math breaks. Let me put this in perspective. A 6% annual deficit compounding over 5 years means we're short approximately 30% of needed supply by 2031. That's not a rounding error. That's a civilization-level infrastructure crisis. I want you to imagine what happens when the institutions realize this. When the big commodity trading desks at Goldman, JP Morgan, and Trafigura run these same numbers and conclude that copper at $6.41 per pound is cheap, not expensive, cheap. They don't buy in that scenario. They seize. They lock up supply agreements. They buy mines. They go directly to producers and offer premium contracts for guaranteed delivery. We're 60% through this analysis. We know silver is the headline, but copper and uranium are the structural winners. We know supply is falling, Glencore down 11%. We know the math shows a massive deficit that widens every year. Now let me show you what the end game looks like. When supply-demand imbalances reach this level, institutions don't wait for the market to fix itself. They take control of the physical assets. Watch for the Rio Tinto and Glencore consolidation. These are the largest mining companies in the world. They're not expanding because they found amazing new deposits. They're consolidating because they know they can't find new deposits fast enough. It's easier to buy existing production than to permit and build new mines. That's a dark signal. When the biggest players in an industry stop exploring and start acquiring, they're telling you the easy resources are gone. They're telling you we're in a mature, supply-constrained market where owning existing assets is more valuable than searching for new ones. And I've seen this playbook before in other commodity cycles. It's what happened in the oil industry in the late 2000s. The majors stopped exploring for new mega projects and started buying each other. They knew peak conventional oil was approaching. The same pattern is emerging in base metals now. Now, here are the specific indicators I'm watching. I check these almost every day because they tell me how close we are to a genuine supply crisis. First, LME inventory levels. The London Metal Exchange warehouses hold the global buffer stock of copper. If those inventories drop below 80,000 tons, we're in squeeze territory. There's no cushion left. Every supply disruption becomes a price spike. Every production miss becomes a crisis. I was looking at the data a few hours ago, and we're trending toward that level faster than I expected. We're currently sitting around 120,000 tons. That might sound comfortable, but we've been drawing down at a rate of about 10,000 tons per month. Do the math. We could hit critical levels by summer. Second, uranium term contracts. Utilities typically sign long-term contracts for uranium fuel delivery. These contracts are negotiated quietly, often years in advance. If utilities start signing deals above $110 per pound, that tells you they're panicking. They're willing to pay premium prices now to guarantee fuel 5 years from now. That would signal the uranium renaissance is permanent, not a cyclical bounce, a structural repricing of nuclear fuel. Third, media narratives. I know this sounds conspiratorial, but pay attention to what financial media focuses on. If they keep pushing the gold and silver story while ignoring copper and uranium, that's not an accident. It keeps retail capital focused on precious metals, while institutions quietly accumulate the industrial metals that actually power the grid. I'm not saying there's a coordinated conspiracy. I'm saying the incentives align. Financial media makes money on clicks and drama. Precious metals are dramatic. Industrial metals are boring until they're not. By the time copper hits $10 per pound and the mainstream media finally covers it, the big move will already be over. The institutions will have positioned months earlier. But you don't care about what they do. You care about what I'm doing with my own capital. So let me tell you exactly that. I believe we are witnessing a once-in-a-century rotation. Silver had its GameStop moment at $117. It was beautiful. I made money on it. A lot of people made money on it. But that move is aging. Copper at $6.41 per pound is just the first inning of a fundamental repricing. We're not in bubble territory. We're in the early stages of a structural supercycle where prices have to rise to ration supply among competing users. Here's what I'm personally doing. And I want to be very clear. This is not financial advice. This is me sharing my own plan so you understand how I'm thinking about this market. If copper holds above $6.30 per pound through February, I would personally look to increase my exposure to major producers. I'm watching Southern Copper Corporation closely. They have low-cost operations, strong balance sheets, and production profiles that benefit directly from sustained high copper prices. I'm not buying random junior miners with no production. I want companies that are actually pulling metal out of the ground right now, with proven reserves and competent management teams. I've been burned by juniors before. They look great on paper until you realize they'll never get past the permitting stage. If uranium breaches the $100 per pound barrier and stays there for more than a week, I'm looking at uranium-focused equities and ETFs. Specifically, I'd consider adding to positions in funds that hold physical uranium and companies with operating mines or near-term production timelines. The juniors in uranium are tempting because of leverage, but most of them will never get a mine permitted. The regulatory environment for uranium is brutal. I want to own companies that already have licenses, infrastructure, and experienced teams who know how to navigate the permitting nightmare. Now here's the trickier part. If silver falls below $110 per ounce, I wouldn't panic. I'd likely treat that as a signal to harvest those gains and rotate them into uranium ETFs or copper-focused positions. Silver could absolutely go higher. I'm not calling a top, but if I had to choose between holding silver at $110 or buying more exposure to copper and uranium at current prices, I know which side of that trade I want to be on. The risk-reward has shifted. Silver has already delivered a massive move. Copper and uranium are still in the early innings of their structural repricing. I've been in this market long enough to know that the biggest gains come from being early to a theme that hasn't fully played out yet, not from chasing something that already went parabolic. The transition is happening now. The question is whether you're watching the right chart. There's an uncomfortable truth that doesn't get talked about enough in commodity markets. We stopped investing in mining during the 2010s. ESG pressures, low commodity prices, and a general sense that we had enough supply led to a decade of underinvestment. Now we need that supply. Desperately. And it doesn't exist. You can't will a copper mine into existence. You can't print it like currency. You can't create it with monetary policy. You have to find an ore body, prove it's economically viable, secure permits from multiple levels of government, raise billions in financing, build infrastructure, hire skilled workers, and then operate safely for decades. That process takes 15 years in a best-case scenario, often longer. We're now facing demand from AI, electrification, and renewable energy that requires supply investments we should have made in 2012. We're behind. Way behind. And here's the worst part. Even if every mining company on Earth suddenly decided to build new copper mines tomorrow, those mines wouldn't produce a single pound of copper until the late 2030s. The lead time is fixed. You can't compress 15 years of geology, engineering, and permitting into 5 years just because you're willing to spend more money. This is what I call the lead time monster. It's the gap between when you realize you need supply and when that supply can physically exist. During that gap, prices have to rise high enough to destroy demand, force substitution, or ration existing supply. Among the most critical users, we're entering that gap right now. And based on the uranium numbers I saw this morning, the gap might be even wider than the copper market. Uranium has an additional problem. The nuclear industry almost died after Fukushima. Utilities canceled reactor projects. Uranium miners went bankrupt. The entire supply chain atrophied. Now we're facing a nuclear renaissance driven by climate concerns, energy security, and the massive baseload power requirements of AI data centers. Utilities want to bring reactors online. Tech companies want to build next-generation small modular reactors. But the uranium fuel supply chain is fragile. We shut down enrichment facilities. We stopped exploring for new deposits. The workers with specialized knowledge retired. You can't just flip a switch and restart that industry overnight. It takes years to rebuild supply chains, train workers, and bring dormant facilities back online. Meanwhile, demand is accelerating, and the U.S. ban on Russian uranium is going to remove a significant chunk of supply from Western markets by 2028. The math is brutal. The timeline is unforgiving, and the market is only just beginning to price this in. What the charts aren't telling you, price charts show you what happened. They don't show you why it happened or what happens next. That requires understanding the physical flows underneath the financial layer. Right now, if you look at a copper price chart, you see new all-time highs, bullish, strong. But the chart doesn't show you that LME inventories are trending toward critically low levels. It doesn't show you that Chinese smelters are cutting production because they can't source enough concentrate. It doesn't show you that Glencore's 11% production miss is just the first domino. The chart shows you the effect. I'm trying to show you the cause. Uranium charts show a strong uptrend, but they don't show you the quiet panic among utility procurement officers who are realizing they might not be able to source fuel for reactors coming online in 2028. They don't show you the classified conversations between government agencies and mining companies about strategic reserves. Financial markets are forward-looking, but they're also slow to price in physical realities. Traders focus on quarterly earnings, Fed policy, and technical levels. They don't spend much time thinking about ore grades or enrichment capacity. That creates opportunity. When you understand the physical supply chain better than the market does, you can position before the crowd. I'm not smarter than the market. I just focus on different data. I read mining engineer reports instead of analyst price targets. I look at actual production numbers instead of guidance. I track inventories instead of sentiment. And right now, everything I'm seeing in the physical supply chain says we're heading into a deficit that's going to shock people who only watch price charts. There's a specific mining report I read last week from a Chilean copper operation. The engineer noted that their ore grade had dropped from 0.8% to 0.55% over the last 18 months. Same mine, same equipment, same workforce. But they're now processing almost 50% more rock to get the same amount of copper. That's the hidden crisis. The charts don't capture it. But it's destroying the economics of existing mines and making new mines even harder to justify financially. Let me walk through how I'm thinking about this rotation in practical terms. Not theory, not predictions, just the actual decision framework I'm using. Step 1, I'm not selling all my silver. I still believe in precious metals as a long-term wealth preservation strategy, but I am taking profits on positions that have doubled or tripled. I'm not waiting for the perfect top. I'm harvesting gains while the market is still liquid and enthusiastic. Step 2, I'm rotating those profits into a barbell strategy. On one side, I want exposure to large-cap copper producers with strong balance sheets and existing production. On the other side, I want leveraged exposure to uranium through ETFs or well-positioned miners. The barbell gives me different risk profiles. The copper majors are relatively stable with dividend yields and proven operations. The uranium positions are more volatile but offer potential for significant upside if the supply crisis materializes the way I think it will. Step 3, I'm watching specific trigger points before I add more capital. I don't buy just because I believe a thesis. I wait for price confirmation that the market is starting to recognize what I'm seeing in the data. For copper, that trigger is holding above $6.30 per pound through February. If it holds, I interpret that as a structural floor. The market is telling me that $6.30 is the new normal, not a temporary spike. For uranium, the trigger is a sustained break above $100 per pound. I don't care about intraday spikes. I want to see it trade above 100 for at least a week with healthy volume. That tells me institutions are positioning, not just speculators gambling on headlines. Step 4, I'm keeping cash reserves for volatility. These markets can whipsaw violently. I don't want to be fully invested at the exact moment the market decides to retest support levels. Cash gives me optionality. If we get a sharp pullback in copper or uranium due to temporary demand concerns or macro fear, I can add to positions at better prices. If markets keep rallying, I still have meaningful exposure through my existing positions. This isn't sexy, it's not dramatic, but it's how I've survived 12 years in commodity markets without blowing up my account. I learned this the hard way during the 2014 oil crash. I was fully invested in energy when crude went from $100 to $30. I had no cash to buy the dip. I had to watch generational buying opportunities pass by because I was already fully deployed at much higher prices. Never again. I always keep at least 20% in cash now. It's my insurance policy against my own overconfidence. There's an aspect of this story that's flying completely under the radar. Big tech's energy consumption is about to explode. Not grow, explode. AI training runs are energy intensive beyond anything we've seen in computing. A single large language model training run can consume as much electricity as a small city uses in a month. And we're not training one model. We're training hundreds, thousands. Every tech company is racing to build AI infrastructure. They're buying power purchase agreements directly from utilities. They're investing in nuclear reactors. They're securing uranium fuel supplies before the public market even knows there's a shortage coming. Microsoft just announced plans for data centers that will require gigawatts of baseload power. Not megawatts, gigawatts. That's nuclear power plant scale. Google, Meta, Amazon, they're all doing the same thing. They're building energy-intensive AI infrastructure faster than the grid can support it. And here's the kicker. They have effectively unlimited capital. When a utility or a mining company negotiates with Microsoft or Google, they're not negotiating with a price-sensitive buyer. They're negotiating with a company that will pay almost anything to secure supply because the alternative is their AI development roadmap gets delayed. That's not a normal market dynamic. That's a buyer with infinite demand and zero price sensitivity competing against utilities and industrial users who do have budget constraints. Who do you think wins that bidding war? This is why I'm watching uranium so closely. If big tech decides nuclear is the only way to power their AI ambitions, and the evidence suggests they already have, they're going to consume uranium fuel at a rate that leaves very little for everyone else. The public utility grid is going to be competing for scraps. And when utilities can't source enough fuel, they start paying whatever it takes. That's when uranium prices don't just rise, they spike. We saw a preview of this dynamic in natural gas markets. Data centers consumed so much power that regions started experiencing summer blackouts. Utilities had to pay emergency prices to keep the lights on. Now imagine that scenario, but with uranium fuel that has 15-year lead times and geopolitical supply constraints. The market hasn't priced this in yet, but it will. I haven't even fully addressed the geopolitical dimension of this crisis, and it's significant. Kazakhstan produces 43% of global uranium. One country, 43%. If you understand anything about supply chain risk, that number should terrify you. Kazakhstan is increasingly asserting resource nationalism. They're realizing they hold leverage. They're demanding better terms from foreign buyers. They're prioritizing domestic energy security over export commitments. What happens if Kazakhstan decides to restrict exports? What happens if political instability disrupts production? What happens if they sign exclusive supply deals with China or Russia? Western utilities and tech companies would be scrambling for alternative sources that don't exist in sufficient quantities. This isn't speculation. This is the exact scenario energy security analysts are wargaming right now. And based on recent policy signals from Kazakhstan's government, it's not a remote possibility. It's a plausible near-term risk. The US and European countries are trying to diversify uranium supply chains. They're restarting dormant mines. They're exploring new deposits in friendly jurisdictions. But this takes years, maybe decades. Meanwhile, the 2028 deadline for the Russian uranium ban is approaching fast. When that supply disappears from Western markets, where does it come from? Canada, Australia, Africa? All of those regions have uranium deposits, but they're not producing anywhere near enough to replace Russian supply. The geopolitical map of uranium supply is broken, and nobody has a good plan to fix it in time. This is why I believe uranium prices at $98 per pound are cheap. Not expensive, cheap. The market is pricing in supply from sources that might not be accessible 2 years from now. And there's another angle here that's not getting enough attention. China is stockpiling uranium. They're building reactors at a pace that makes Western nuclear programs look glacial. They're securing long-term supply agreements with every uranium producer they can find. When China stockpiles a commodity, you should pay attention. They have a 40-year planning horizon. They don't speculate. They secure resources they know they'll need for the next generation of infrastructure. If China is aggressively buying uranium now, what do they know that the market doesn't? I've been through commodity cycles before. I've seen boom and bust in oil, copper, iron ore, even rare earths. Most cycles follow a predictable pattern. Prices spike, supply responds, prices crash, miners go bankrupt, the cycle repeats. This time feels different, and I don't say that lightly. This time is different are the four most dangerous words in investing. But hear me out. Previous cycles were driven by temporary demand surges that could be satisfied by bringing existing capacity online or building new mines within a reasonable time frame. China's industrialization in the 2000s created huge demand, but the supply response worked. Mines got built, the deficit closed. This cycle is different because the demand drivers are structural and the supply response is broken. We're not talking about cyclical industrial demand that ebbs and flows with economic cycles. We're talking about a permanent shift in how humanity generates and consumes energy. Electric vehicles aren't going back to gasoline. AI data centers aren't shutting down. The renewable energy transition isn't reversing. These are one-way doors, and all of them require massive amounts of copper and uranium. Meanwhile, the supply side is fundamentally constrained by geology and lead times that can't be shortened no matter how much money you throw at the problem. That's why I think we're entering a multi-decade structural supercycle. Not a 3-year boom followed by a crash, a fundamental repricing of industrial metals that reflects their new role as bottleneck resources in the energy transition. Final thoughts and the path forward. We're at an inflection point. The commodity supercycle everyone predicted in 2020 and 2021 is finally arriving, but it's not playing out the way most people expected. It's not broad-based across all commodities. It's hyper-focused on the industrial metals that enable electrification and energy infrastructure. Copper, uranium, the boring stuff that actually powers civilization. Silver had its moment. Gold might have another leg higher. But the real structural repricing is happening in the metals that most retail investors don't even think about. I've been stacking silver for 12 years. I love precious metals. But I'm not in this market to be loyal to a metal. I'm here to position capital where the fundamentals are most compelling. And right now, the fundamentals are screaming that we have a supply crisis in copper and uranium that's going to take years to resolve. Prices have to rise. There's no other way to ration finite supply among competing users. The institutions know this. Big tech knows this. Mining executives know this. The market is slowly figuring it out. My personal plan is to continue rotating out of precious metals that have already delivered significant gains and into industrial energy metals that are still early in their structural repricing. If copper holds above 630 through February, I'm adding to major producers. If uranium breaks through 100 and holds, I'm increasing exposure to uranium-focused equities and ETFs. I'm keeping cash reserves for volatility. I'm watching LME inventory levels like a hawk. I'm reading every production report from major miners. This isn't financial advice. This is me telling you exactly what I'm doing and why. You can agree with my thesis or not. You can follow a similar strategy or do something completely different. But at minimum, I want you to stop staring at the silver chart and start asking yourself a harder question. What happens when the world realizes we don't have enough copper to build the electrified future we've already promised ourselves? What happens when utilities start bidding against big tech for uranium fuel? What happens when the lead time monster finally catches up to the energy grid? Those are the questions that keep me up at night, and they're the reason I'm positioning the way I am. Let me leave you with the numbers that matter. As of this morning, copper is at $6.41 per pound. New all-time high. Uranium is at $98.30 per pound, up nearly 8% in a single session. Silver is at $117.06. Impressive, but sideways. LME copper inventories are trending toward critically low levels. Glencore's production is down 11%. Ore grades continue to decline. The global deficit is widening. Big tech is locking in nuclear fuel supplies under NDA. Kazakhstan is pivoting toward resource nationalism. The US ban on Russian uranium kicks in by 2028. The math doesn't work. The supply doesn't exist. The lead times are unforgiving. If you want to understand how the gold to copper ratio is predicting this exact shift, go watch my previous breakdown on the commodity supercycle. I walk through the historical patterns that suggest we're entering a multi-year repricing of industrial metals relative to precious metals. The real money isn't made chasing headlines. It's made positioning early for structural shifts that haven't fully played out yet. Silver's parabolic run was beautiful. I'm grateful for it. But it's not the main story anymore. Watch the inventory levels. Watch the production reports. Watch what big tech is doing with their energy contracts. The next phase of this cycle is going to be brutal for anyone caught on the wrong side of the supply deficit. And if I'm right about the structural dynamics in copper and uranium, the gains we saw in silver are going to look modest compared to what's coming in the industrial energy metals. Don't get blinded by the $117 headline. The real wealth transfer is happening where the lead time monster meets the AI revolution. See you in the next one.